Hello there. Welcome to the show. Fixing my glasses. It's good to have you. Let me get the intro ready. I didn't mean to hit the go live button so quickly and easily, but that's how good I am at this. I just hit the live button and we go. Switch to the main camera. Thank you for joining me. By the way, I'm Mitch, client for strategy. The show is called "Be the Boss of Your Money." Did you see that article on CNBC? How podcasters, in particular video casters, as they call us, are becoming more important in the media. You have live sports, which is like the pinnacle, the most important, valuable part of media. But the podcasters, just the conversations, uh, that's what people are really into. So maybe I was ahead of the curve a little bit, but I'm really enjoying the show. Been doing this for a couple of years now, since 2019. And it's all about common sense here. It's about making sense of the markets and investing. And a lot of times it's hard to do because things don't always make sense in the market. It's a lot of emotions go into this. And sometimes, some people have one set of emotions. Sometimes people have another set of emotions, and they kind of balance each other out. But what we had in the stock market was just, to me, I've never seen a move like this, from manic depressive, like crazy sadness, to euphoria, as Billy Joel would say. It's always sadness or euphoria, right? You know the song? But this is the most manic depressive market I've ever seen, and I've been doing this for 36 years now. I know I don't look it. I know, and it's quite easy to see, quite conceivable, new highs are on the way, and that's what we're going to talk about. Like, what did you do the last couple of months? Because people were advising changes. People were all over the financial media, were articles like, 3 stocks to ride out the tariffs, 5 stocks that could actually benefit from tariffs, safe havens to buy now, gold is going to X number, right? Drug stocks should do well no matter what. By the way, drug stocks are doing horrible since the China news came out. The China tariffs news came out over the weekend, and now Trump wants to negotiate drug prices with drug companies because we're paying more than every other industrialized nation for our drugs. And that is something with an overwhelming political majority. That's something that the left has been trying to fight. Now the right wants to get into that fight too. And if there's one thing that Republicans and Democrats could agree on, price of drugs are so damn high, and it's costing us a fortune as a nation. So a lot going on. We're going to talk about this. So now I'm going to roll that quick little intro video about 3.5 minutes into the show. And we're going to talk about, what did you do in this market? How did you stay sane? Why I think we're going to be tested many, many more times. And we'll take a look at some of the FANG stocks, as giant tech stocks. 3 of them are now in positive territory this year, and one of them is pretty close to taking on a new high. Here we go. All right, thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money, and that's what the show is about. I just want you to make better decisions with your money, with your investments. I want you to be educated. I want you to be educated on what happens in the real world. That's what the show is about. And we're not, we call balls and strikes here. We don't care what uniform the players or the companies are wearing. We just want our clients to do well, because when we all do well and when you do well, we're all happier. right? Happy is a good thing. So don't worry, be happy. Straightening out my glasses again. Every time I put the headset on, it is this with my glasses. Okay. Is that better? All right, it's better. So let's just talk real quick. We had this crazy down market tariffs, and we had I wouldn't say a reversal. The tariffs are now the highest they've ever been, even with the 10% base tariff. That's really high. Historically, even that's a pretty high base. The reciprocal tariffs were put on pause on. They were supposed to go into effect on April 2nd, and they were paused at April 9th. The market shot up with a giant up day, like 10%. I think the Nasdaq went up like 13% in one day. Huge. I mean, it's just you get a couple of rallies like that in your entire life. That's how big that rally was. And then we started giving a little bit back, but then it started to become more positive in the environment with maybe we'll start talking to China again. And I've always said from the beginning, I don't think tariffs are a bad tool. I don't think they're a good tool. It's just a tool. And like any tool, if you use it right, it's a good thing. And if you want to use it to encourage behavior from another country, if you want to retaliate against another country's bad trading practices, or if you want to make a statement, bring trading partners to the table, it could be good for that. Could also be good if you. Well, those are really the three things that it's for. I've often said that doing a 145% tariff and 30 or 40% tariffs on other nations all at once is not really a workable strategy. It would really send us into a pretty nasty recession, and somebody would have to blink. But if you start at maybe 5% this year, 5% next year, gradually do it, you probably would get the same, a lot of the benefits. And odds are they wouldn't be rolled back by outside circumstances, either a change in the political environment or a change in the economic environment. I have to bring up political because that's what the tariffs are. Well, they're economic, but we have to talk about how politics and the economy intersect. And that's one of those times. And I feel like if I just try to make pretend politics has nothing to do with anything and ignore it, I'm being, Pollyanna. Like you're talking about everything but the elephant in the room. But cooler heads do seem to be prevailing. President Trump backed down. Chinese have backed down. We'll see where we go. Everybody wants something. It's really tough to say. Trump is in the Middle East. From today, an announcement on Boeing's, I think Boeing's like biggest order ever, like 200 some odd Dreamliner aircraft that'll be delivered to Qatar. I don't know how long it's going to take. That'll probably be like a 10-year deal. But a lot of big announcements are coming out of this trip. So, and it's getting individual stocks build up. When Boeing works, it's good for Boeing, it's good for GE, it's good for lots of companies that feed off of Boeing's business. Drug stocks, which were seen as a safe haven in this tough market, are looking pretty bad all of a sudden, right? So they're looking poor. Utilities are off a little bit. What worked out to the sectors are up today are consumer discretion, communication services, which is, by the way, mostly technology, and XLK. Just when I say communication services, you're probably thinking that's all AT&T, and it's all Verizon, or that's it. But that's not true. I'm looking at the profile. I don't mean to be turning my head away from you, but in the communications sector, Meta, Alphabet, and Netflix represent like almost 40% of that sector. AT&T and Verizon combined are a little bit less than 10% of the communication sector. So the communication sector to me is still largely a it's still largely a tech sector, right? But let's make this a little bit bigger so you can I'll show it to you over here, okay? All right, let me pop myself up on the screen. All right, so you see where what's in communications, Meta, Alpha. There's two alphabets, right? Because there's Class A and Class B, Class C. So that's about 16% of that particular index. So it's AT&T and Verizon are nothing in particular in that index. Take Two Interactive, which makes games, video games like Grand Theft Auto, which my kids love. So that's what's in that. But I'll show you something else, okay? Of the Mag 7 stocks, these are the stocks you talk about all the time. All the time. Let me make that a little bit bigger, all right? Meta is up almost 13%. That's Facebook. Microsoft is up 7%. NVIDIA is up a little bit. NVIDIA went out today at like 134, 135. The high is 153. I mean, we could be like a week away from NVIDIA hitting a new all-time high. Amazon is down 4%, Google down 13%, Tesla down 13%, and Apple down 15%. In the scheme of things, if you're a long-term holder, these aren't big drops for these stocks. You've made a lot of money in these. If you're a Johnny-come-lately and you decided Trump won in November in the last election, so now you're going to go all in on stocks, now things are going to be great. You paid the highs across the board, and hopefully you're stuck with it because you're starting to get back to even. Now, how did you react in this crazy market? Like, did you do things that you're now regretting? Did you feel when the market was going down in the last couple of months that you had too much in stocks? Did you feel like, I was up so much in a particular stock, whatever the name is, I wish I took some gains because now the stock is down like 35, 40% from where it was. The whole gain is gone. I've got a little bit of a gain left, or I've got a little bit of a loss now. I'm so mad at myself. I swore I'd never do this again. And I let it go. Like, what was your strategy to avoid giving back a big gain? And maybe you sold and now you have to get back in. So I could give you a strategy to get back in. It's pretty easy. Start buying. There's ways to buy. You could use limit orders, buy limit orders. There's a few things you could do. But ultimately, if you're not in it, you can't win it. You know what I mean? You got to be in it to play it. There's no other way around it. So what do we do? What do we do before this? Like, how do we avoid making the same mistakes over and over? I have a friend. He just always seems to sell when things go down, and he always seems to buy back in when things go up. And I'm like, you got to stop that. And it's not about like, should you buy Amazon because it could go up $30, or you think you'll get a quick trade out of Enphase or Nvidia or whatever, First Solar, whatever stock you're trading. I'm not knocking the stocks. I'm knocking the actual some of the buyers and sellers, though, and that might be you. And if that hurts, I'm sorry. I don't sugarcoat things. What were you doing wrong? Now, if you have some of your money for trading, that's your idea of investing, that you just want to jump in stocks, you could think of a big run, and then you'll jump into another one after that and another one after that. It's very old school. It sounds like it's very 1980s, very 1990s to me. All right. But the way I prefer to do it is have a portfolio that you could live with. So if it goes down, it was built into the expectations that it's going to be up and down. It's harder to do that, I think, with individual stocks, because you start to worry, what if I have the group of individual stocks that don't come back, but the index will have both, right? Like the S&P 500 index funds. All right. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. So, were you too concentrated in a couple of stocks? Maybe when you started buying stocks 5 years ago or 3 years ago, if you weren't overly concentrated in Meta and Nvidia and the other Mag 7 stocks, but they went up so much. And then you got like $2 million in these stocks, and you're like, this is great. I'm not selling now. I'll sell before they go down. Don't worry. People don't do that. What you do is you take profits along the way and you use that profit money to do something else with. You could diversify into other sectors, other stocks. Like I don't want to sell Nvidia, take profits in Nvidia, and then buy Broadcom or AMD or Texas Instruments. That's not to me what I really want to do. It's kind of old school, I guess, but it's not the way I'd want to do it. And diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But it's important because it could help your portfolio go down less. It could help your portfolio recover quicker, from a down market. The other thing is diversification is important because not all of your investments are going to do well at the same time. But if you diversified, the expectation is over time, we expect more of your investments over time to do well than not. If you're just investing with, index ETFs, your large cap, ETF, your mid cap, your small cap, your international, your bond ETF, maybe you have a real estate ETF or a utility stock ETF. Odds are all of those will do well over the long term. They just won't all do well on the same day, the same month, or the same year, or the same decade. And that's why it's important to diversify. Because what if you put all your money into Nvidia? Not that that's a strategy, but that's like a really stretchy, exaggerated example. But what if that stock went down for 6 years? A lot of the problem with investing comes because we are going to need the money eventually. I mean, most of you who are investing are not doing this to be an investor. You're doing this because one day you're going to start needing to take the money out. And if you take the money out when the market goes down a lot, or you have too much in tech stocks, and the S&P 500 between tech and communications is like 40% in that area. And I just went over communications with you, which is basically tech. So you basically have a 40% hit. When that takes a big hit, it has an exaggerated effect on your portfolio, even if you're diversified. I guess what I'm saying is the S&P 500 is not nearly as diversified as it was 20 or 30 years ago. I like to say it's not your father's S&P 500. It's a supercharged, tech-heavy index. Now, that makes sense for now because that's where we're getting valuations, that's where we're getting earnings growth, revenue growth, and of course, we're getting innovation. But everything is cyclical. So having said that, maybe you need to take profits more often on stocks that are going up. You might not have needed to do that when you were 30 or 40, but if you're 50 or 60, maybe you start to need to take money out of profits. You may need to take some profits out of winners and put that into other places. Maybe you needed to buy a treasury bond. Maybe you needed to buy a different kind of stock, go from a tech stock to a bank stock or a drug stock or utility stock, and really use these rallies to build out a truly diversified portfolio. That's what I do, and that's how I manage my clients' money, by the way. I like to eventually take profits in stocks, not all of it. I don't say I have to sell the whole stock. But, if you have, money in Meta, Facebook, and it goes up a lot, you could take 5 or 10% of the value of what it is now and put that into something else, and then do it again with other stocks. And before you know it, you've got a truly diversified portfolio. Sometimes you might even have too much diversification, but eventually some stocks you just wind up exiting altogether, and somehow you get the number of stocks out of your portfolio. You get the number down of the individual stocks to your portfolio. So that's what this is about. It's about what was your strategy that led you to making hasty decisions, I have friends all over the place who are financial advisors and not. People, not everybody's my client, and that's okay. I don't make friends based on being a client or not, okay? But I know what people are doing because they kind of say on the side, I sold out. I didn't want to take too much of a hit. And I have to get back in. And do I buy now? Do I wait? The problem with waiting is that everybody's waiting and the market keeps going up. That's why the market keeps going up, because when people are waiting to buy, it means they're still sitting on cash. So that cash is fuel for the next rally. And there's a lot of fuel now on the sideline. So you've got a lot of money managers and individual investors who built up their cash reserves in their accounts, and now they're putting the money back to work. And the more the market goes up, the more you want to buy, because it's hard to see the market go up when you're in too much cash. And if you're a professional, let me go. There's two kinds of professionals, all right? Two. The first professional is this. As far as investing professional goes, if you're managing a mutual fund or a hedge fund or an actively managed exchange traded fund, for example, you have to worry about performance. And if you were like, you're going to be clever and you're a fund manager or a hedge fund manager, whatever it may be, and you decide the market's too risky, the tariffs are too much for the market to handle, it's going to be, you may be thinking it's going to be a really bad recession, earnings are going to plunge, stock prices are going to compress. So you decided to take money out of stocks, move it into cash equivalents, T-bills, that sort of thing. The market turns around, and now the market's up a little bit this year, but you're still down like 5 or 10% on the year. Now you're a terrible performing manager. Now, if you're close to what the market is doing, that's okay. But if you're really far off, it could be a problem for some of your shareholders, and they might take the money out of the fund, right? When you give up on an ETF or a mutual fund, that's your way of firing that manager. People will do that. And now, now these managers, they have to rush out and buy not just the stocks that are going up the most, they have to show them on the books for window dressing. So at least they could say at the quarterly report, on their filings that they own the best stocks, but they have to buy the stocks that can go up the most, which are often the riskiest, because now they have to make up for lost time. Now they have to figure out, how am I going to get to positive territory if I'm negative 15% in the year? If you think about it, this year is going by pretty quick. 2025 is almost halfway over. This year is, they all fly by, but they all fly by faster, but like we are almost to the midpoint of 2025 already. And then there's the other kind of manager, and that is your own financial professional, your own financial advisor. Maybe they got too much into negativity. They were trying to protect you, or they were trying to be clever and say, I'm going to hide out in assets that I think could hold up. I'm not knocking anyone. I like it that financial advisors want to protect their clients. But you also have to go by the client's goals. Are you doing this for a client who should be maybe 30% stock and 70% bonds, but somehow they get up to 50% stock? Or maybe you're doing this for a client who started out 10 years ago at 50% stock, 50% bonds, and now they're like 70% or 80% stocks, but really they should be only 30% stocks. When I make a move for a client in terms of how much money is in stocks and bonds, it's really based on their time horizon. Now, a lot of people don't know what time horizon is, but I think time horizon is the most important determinant of what somebody's risk tolerance could be. The time horizon isn't necessarily like till the day you think you could die. Well, because I put in my financial plans for clients that they live till 92. It's just kind of a default I use. I could change it, I could make it higher or lower, but as a default, when I go over somebody's financial plan and I run the Monte Carlo simulations, I'm typically going by age 92. If the client lives to 92, what could they have? If they live till 95, I look at what they can have, but generally speaking, 92 is just where I start. Okay. If some clients, they say, I'm never going to make it to 92, can use 85. Not only that, I'll be able to live a little bit better while I'm still here. Everyone's different, and it's a personal situation. And this is why financial planning, this is why financial planning needs a very high degree of flexibility, because the inputs could be very subjective. My Dunkin' iced coffee. It's iced coffee season, and it's my favorite season. Iced coffee. So, uh, to me, time horizon means the time to go until you start needing to live off your assets. It doesn't necessarily mean retirement date. Now, retirement date is often thought of as a hard and fast rule that the day you retire, the next day, the day after you retire, you have to start converting your assets into cash to pay for your lifestyle. We start that conversion process from stocks to more stable assets well in advance of your retirement. But we also keep in mind that if you retire at 64, you could live another 25 years. So we still want to keep the money growing, because if you think inflation's been high the last 5 years, wait till you see what inflation's going to do over the next 25 years. This is why people who are old hate inflation, because they're starting to see their accounts dwindle, and they start to really worry about losing money, not about running out of money. They start to worry about running out of money. So the glide path is important. But overall, if the glide path means, at what point do we start decreasing risk assets and move money into more stable assets like cash equivalents, short-term bonds. There are longer-term bonds. We do that too, but that I wouldn't call that so stable. Long-term bond funds are actually pretty volatile. Also, people think, well, it's a bond fund, it's safe. No, bond funds could go down and never recover. I'll tell you, some of the biggest losses I've ever seen are from people who bought bond ETFs during the pandemic, when interest rates were really low and the Fed funds rate was between 0 and 0.25%. I don't know if those particular bond ETFs will ever recover. Unless you see the Fed cut rates again and you see the 10-year yield go down to like 1.5%, I don't see how those bond ETFs ever recover. But that's the nature of investing. This is why we don't put all our money into long-term bond funds. And this is why I like to use individual bonds, because they have a maturity and they allow me to not only get 100 cents on the dollar at maturity, I get to reinvest into a new bond. And that's why we ladder our bonds. So some are 6-month maturities, some bonds are 1 year, year and a half, 2 years, 3 years, 5 years, and so on. Okay, so maybe your financial advisor got you a little too conservative. Or maybe your financial advisor let you get too aggressive because the value of your accounts went up so much based on individual stocks, didn't rebalance, and you're still doing pretty good. It sucks to see some of your gains go away, but you're still further ahead had the advisor not let you get as aggressive as you are on stocks. These are all the things that come into play when you sit down with a client. It's not just about putting your money into an S&P 500 fund. If that was all it took, we wouldn't even need to have this conversation. The S&P 500 fund is a tool. And like any other tool, if you use it correctly for the right job, then it's a good tool. But you can't build your financial house, your investment portfolio, just with tools. It's like building a house with hammers. No, you build a house with wood and copper and nails. The hammer is just a tool. And that's what stocks are, and ETFs and mutual funds and bond funds. These are just tools. NVIDIA is not a source of pride to own the stock. It's just a tool. It shows strong historical performance. It's expected to show strong performance going forward. No guarantees. That's why we use the word expected. And that's why we would own a stock like that, for example. But these are tools. So the discussion wraps up like this. If you are someone who is subjected to, you subject yourself to being in and out of the market, to getting nervous when the market goes down, because when we have these nervous situations, When we have these nervous situations like the pandemic, like the tech wreck of 2000, the Great Recession of '07 to '09, like the tariff, the very short-lived bear market that we just had, some people are very subject to making hasty decisions, and those come back to haunt you because when you're going through that moment, it feels like it's never going to end, and things are never going to be good for the stock market again, and you need to just protect what you have, and you're going to live on bread and water and just be grateful that you have what you have because you're so nervous. But when that wears off and the dark clouds dissipate and you see that the market is recovered and you wonder to yourself, why did I make all these panic moves? This message today is really for you. There's a lot of people who do that, and that's where financial advisors do come in handy to reassure you along the way that you are doing the right thing. If you then panic and get scared during this down market, the financial advisor may have set you up with the right portfolio, and you may have met in person with your financial advisor, and you have the comfort of knowing that someone's on top of it and someone is moving that glide path from stocks to bonds and all these other things that are important to do to keep you invested long term. Remember, it's not about timing the market, it's about time in the market. And what good is an investment portfolio if you can't stick with it? And we just want you to stick with it. That's the most important goal with investing. I'd rather you invest conservatively and underperform all the growth out that could happen in the next 25 years than invest for raw growth, but panic every time the market goes down, and then you get out and get back in because now you're just, you're just a loser. You're just setting yourself back every time. You're creating wonderful opportunities for another investor to buy cheap, but you're not doing yourself any favors. All right. That's the show for today. I hope this helps. If you have any questions, ask in the comments. Reach out to me in the comments. Reach out to me directly. You know where to reach me. I'm all over the internet. You can find me. Reach out. I'd love to have a talk with you. We'll see where it goes, and have a good night. Thank you.